I was 27 years old when I bought my first house, and I thought I had everything figured out. I had saved up for the down payment, found a great place, and I thought I was ready to go. But pretty soon I was hit with closing costs that I did not account for, credit score that was not as strong as I thought it would be, and unexpected repairs that came up when I moved into my house. And that's when I realized buying a house is not about finding a right property, it's about having a right mindset, preparing yourself for buying the house, and have the financial awareness so you don't make the same mistakes that I made. Welcome back to the channel. My name is Harpreet, a financial advisor turned into real estate agent serving Pickering and nearby GTA areas. If you find this video helpful, hit the like button, subscribe, and share with your friends and family or someone you think might benefit from watching this video. You can also book a 50 minutes call with me with the first link in the description below. I always tell all my clients buying a house is very easy. You book some showings, go take a look, put some offers, and your offer might also get accepted. But here is the thing. Planning is really important because buying a house is so easy, but selling is equally tough. You want to make sure you're prepared for this big financial decision of your life and you're fully aware of what is going to come your way once you move into your house. And this is why in this video, we're going to be talking about 5 crucial things you need to know before you even think or start planning about buying a house. And the first question you ask yourself is, can you even afford to buy a house? And here I'm not talking about the down payment. There is so much more to consider other than just the down payment. And also when it comes to down payment, you want to make sure you have at least 10 to 20% saved up for your house. And the reason I emphasize on the word 10% is because that's a sweet spot of minimum down payment you should be putting. And let's be real, if you're buying a house in Toronto, average house price is $1 million and the 10% is not a small amount. That's why planning ahead, saving money becomes really important for you. Here is a breakdown of what you need in addition to the down payment when you're looking to buy a house. But let's start with the down payment first because this is where a lot of people have some misconceptions. In Canada, the minimum down payment you need to put down on a house is 5% if the purchase price is less than $500,000. For anything above $500,000 to $1.5 million, you have to put 10% down payment. And this $1.5 million before December 15 of 2024 used to be $1 million. So now they have increased the cap of minimum down payment that you can put when you're buying a house. I have also made a video on these new mortgage changes and how they can benefit you, and the link is right here. For example, if you're buying a $900,000 house, your minimum down payment would be 5% off $500,000, which is $25,000, and 10% off the remaining $400,000, which is $40,000. So your minimum down payment to qualify for a house of $900,000 would be $65,000. But we also have to take into consideration that your income should be sufficient enough to qualify you for that mortgage amount. So let's say if you decide to put 10% down payment, your minimum down payment would be $90,000. In addition to the down payment, you must have closing costs saved up as well. Closing costs ranges from 1.5% to 4% of your home price value. So for a house which is worth $900,000, you need to have at least $15,000 to $28,000 saved up in addition to your down payment to close on that property. And you might ask, what does closing costs involve? Land transfer makes the biggest portion of a closing cost. In Toronto, you have 2 land transfer taxes. One is municipal, second one is provincial. If you're buying a house outside of Toronto, you only have to pay 1 land transfer tax. But land transfer tax alone can equate to $15,000 to $20,000 when you're buying a house. However, if you're a first-time home buyer, there is some relief from the government. If you're buying a house in Toronto, you get $8,000 in land transfer tax rebate, and anything outside of Toronto would be $4,000. In addition to the land transfer tax, you have to account for lawyer fee, which could be anywhere between $1,500 to $2,500 depending on the property size, which also includes your title insurance, any other registration fees that could incur. Here is a breakdown of lawyer fee and other charges that you can see in a transaction. And then don't forget inspection. Doing an inspection is really important when you're buying an older house because you don't want to get hit with those unexpected repairs as soon as you move in. Inspection could cost you anywhere between $500 to $700 depending on your property size. But it gives you a sense of relief when you're moving into your first house. Now that you have saved up for your down payment, closing costs, lawyer fee, you also have to take into consideration the ongoing cost of having a house. This could involve your maintenance, your property taxes. So the good rule of thumb is you should have at least 1% of your house price saved up and kept aside for any unexpected repairs, property tax, and your day-to-day maintenance of your house. As you start planning your down payment, you also have to take into consideration and ask yourself how much of your monthly income you want to put towards housing expenses. Because in the end, once you buy a house, you do not want to be house poor. The rule of thumb is whenever a bank does your mortgage application, they say your housing cost should not be more than 39% of your gross income. So make sure you leave some room for those vacations, car, your kids' education, because in the end, the house is important, but that is not your life. Second crucial part is credit score. Your credit score plays a crucial role in determining what type of mortgage options you would have available as a buyer. With a credit score of 700 and plus, banks consider you as a low risk profile, allowing you to qualify for best interest rates available in the market as well as best mortgage products. Even a small difference of 0.25 on a mortgage rate could mean a huge financial difference over the course of your mortgage. So this is why it's very important. If you plan to buy a house 1 year from now or 6 months from now, you want to keep a very close eye on your credit score. However, if your credit score is in the low 600s, it might make your situation very tough because big banks like TD, CIBC, RBC might not want to entertain your mortgage application, and you might have to go to B lenders. That means higher interest rates, more down payment, and more complications in your home buying process. And this is why when assessing your mortgage application, lenders consider a lot of factors. For example, one missed payment could be a red flag for the lender, and they might ask you to give them explanation why the payment was missed. Number of inquiries, for example, how many times you have applied for credit cards, line of credit would also impact your mortgage application, because let's say if you're someone who applies for credit card every month, it shows the lender that you are a credit seeker and it positions you as a high risk applicant. And that's why understanding and managing these terms become really important for you as a first-time home buyer who's looking to buy a house 6 months to 1 year from now. So therefore, keep a close eye on your credit score. Do not apply for credit cards or line of credit if you don't need to, and make sure your payments are made on time. And also, let's talk about something super important, which is how you manage your down payment. You want to make sure your down payment stays in 1 or 2 accounts and it's not scattered all over the banks and accounts. The more scattered your down payment is in different accounts, the more proof or paperwork the bank is going to ask you. And let me tell you one thing, that is actually not fun. And another key thing is the bank will always ask you for 3 months to 6 months of your down payment history. So you want to make sure you don't make any changes in your bank account while that money is being saved for buying your house. Let's say you lend some money to your friend and they paid you back. That sounds very simple in your day-to-day life. But when a bank sees a transaction, they might want to ask you the proof of you lending money to your friend and him paying it back to you, and you still have to prove that the money originally belonged to you. So here's a tip. If you're watching this video, that means you're already in the planning stage of buying a house 6 months to 1 year from now. You want to make sure you do not touch your down payment account. Save money in there. Do not make any big transactions in that account. And if you're doing any big transfers, you want to make sure you have all the records of those transactions, as the banks will ask you to prove those transactions, and it will save you a ton of headache later. I'm not a licensed mortgage agent, but if you need more help in preparing yourself for mortgage, make sure you get in touch with a licensed mortgage agent. Number 3 is the importance of having negotiables and non-negotiable. When I was buying a house, I had no list of what I want, what I don't want, and I ended up buying a house with no rental basement suite, which now I realize if I had made a list back then, I would have bought a house with a rental income coming in that would have helped me out today with my mortgage payments. So before you embark on the journey of looking at homes, it's very important you understand your personal needs, your commute time, how many bedrooms you want, and any other individual preferences that you might have. And this is why this thoughtful approach ensures that the house you're going to be looking at aligns with your lifestyle and your long-term goals. And this is why you need a list of non-negotiables and negotiables. In non-negotiable, you can have things like school ratings, distance to work, distance to public transit, as this might impact your everyday life. But when it comes to negotiables, instead of going for a new house, you can go for an older house. Instead of having 3 full washrooms, you can have 2 full washrooms, anything which might not impact your day-to-day life. And having this list ready will give you a competitive advantage, because as soon as you jump in the market and you come across a nice house, you will not be wasting your time on understanding the negotiables and non-negotiables of the property. Number 4, and the most important thing in my opinion, is to ask yourself, is this the right time for you? Just because your friends are buying a home, your family is buying a home, doesn't mean you have to buy a house as well. Sometimes renting is not as bad as many of us might think. But this is why it's very important for you to ask yourself, is this the right time for me to buy the house? So let's say if you're renting a 1-bedroom and den condo in downtown Toronto, you're probably paying somewhere between $2,600 to $2,800 plus your utilities. So let's say all in, you're paying about $3,000. Let's say you decide to buy a brand new $900,000 townhouse in Pickering with 10% down payment. At today's rate, your monthly mortgage payment is going to be $4,200 plus approx $500 in property tax and about $300 in your utilities, plus about $150 in your property insurance. This all adds up to about $5,100. So you have to ask yourself, are you ready to go from $3,000 a month to $5,100 a month? And this is why a lot of time I ask my clients what is right for them. And a lot of time they come back to me and say, hey, I like the idea of buying a house, but I don't want to be house poor. And that's when we look at homes which have rental potential income in the basements. For example, if you buy a $900,000 bungalow, but your lifestyle choice plays a really big role in this decision, because as a home buyer, you might not want to go into an older house for having a rental basement, or you might not want to get into an older property. And that's where you have to ask yourself if you're okay to pay $5,100 every month towards the housing cost. Or if you're someone who says, I don't want to waste $3,000 paying someone else's mortgage and I want to build my own equity, then probably looking into a bungalow or a property that comes with a rentable basement is a better option. For example, if you buy something for $900,000, again with same numbers, and you're making about $2,000 a month from the basement, then your net cost is only $3,100, which is pretty much similar to you renting a condo in downtown Toronto. But there are pros and cons to renting the basement out as well. You're sharing your space with someone, you're sharing your driveway with someone, and you have to be fully okay with you. And that is why if you are planning to buy a house, you really have to take into consideration both the payments, go look at both the type of homes and see which one meets your need, and in the end you decide what you think is the best option for you. Because a lot of time the decisions that we make are not just based on numbers, they're also based on emotions. And you could be at a life stage in your life where you don't want to share the basement, you want to have a brand new house all to yourself, and then going for a house which costs you $5,100 a month might not be a bad idea. But you have to budget your numbers, and you have to have reserve funds for unexpected repairs and situations. So once you feel like you're ready and it's a time for you to jump in the market, you also have to look at the stability of the overall situation. Buying a house, I always say, is very easy, but selling the house is equally tough, and then you're exposed to market ups and downs. So whenever you're buying a house, you have to look at your 5 to 7 years time horizon. A lot of us saw crazy appreciation in 2021, 2022, but that is not how real estate works. Real estate is not a get quick rich scheme. That's why you have to take into consideration that you want to be in that house for at least 5 to 7 years to have proper benefit of the appreciation. That's why it's really important for you to have a long-term vision, buy a property which is fundamentally right, and it doesn't impact you, just in case if anything changes in your financial situation. But you're not alone in this house buying journey. Government has a lot of incentives to help you save up for the down payment as well as for the closing costs, to make it a lot more easier for you to buy your first house. And as a first-time home buyers, if you're not aware of these incentives, you could be leaving thousands of dollars on the table that could be helping you out. 2 game-changing incentives that could save you thousands of dollars and help you towards the down payment, and also help you reduce your taxes. Let's break it down to understand how these 2 accounts can help you and how you can take advantage of these 2 incentives. Think of FHSA account as a baby of RRSP and TFSA account, but for buying a house. You can contribute up to $8,000 per year with a lifetime limit of $40,000 in your FHSA account. And you have about 15 years to use that money for the purchase of your first house. But how does FHSA work? Similar to RRSP, the contributions in FHSA account are tax deductible. And similar to TFSA account, when you take that money out from your FHSA account, there is no tax implications on it, which means your withdrawals would be tax-free, as long as you're using that money to buy a house. You can invest that money in stocks, mutual funds, GICs, anything that can help you grow your savings faster. So let's take a look at this example. If you contribute $8,000 to your FHSA account in a year, you get a tax deduction So if you are in a 30% tax bracket, you will get back $2,400 at tax time. If your investments grow, let's say to $10,000, you can withdraw it all tax-free for your home purchase. So the $8,000 you invested in FHSA account, you got $2,400 as a tax return. Now you have $10,400 in your FHSA account, and you can use that money to invest in stocks and mutual funds and further grow that money. But you must be a first-time home buyer to open up an FHSA account. Even if you're not buying a house in the next 2-3 years, I will still highly recommend you to go and open up an FHSA account and start saving. Next one is Homebuyer's Plan, which allows you to use your RRSP for your down payment. It is pretty much like you borrowing money from your RRSP account to help you fund for your down payment and your closing cost. So how does Homebuyer Plan work? You can withdraw up to $35,000 from your RRSP without paying taxes as long as you use that money for a down payment. If you're buying with a partner, you can both withdraw $35,000, meaning a couple can access $70,000 tax-free for their home. You won't pay taxes on that withdrawal as long as you pay that money back to your RRSP account within 15 years. But there are some repayment rules. You must start repaying the withdrawn amount in year 2 after withdrawal. Each year, you must pay back 1/15 of the amount withdrawn, or else that portion will be added to your taxable income. If you took out $30,000, your minimum repayment is $2,000 per year. If you do not repay that amount each year, it gets added to your taxable income. So if you're contributing money towards your RRSP account, it has huge benefits to help you out with your first-time homebuyer purchase, but you also want to make sure you have plans to pay it back. So buying a house is a really big decision, and that's why you always want to make sure you're prepared for it. You have no regrets when you buy that house, and you have the list of negotiable and non-negotiable, plus all the tools available to you by the government to help you out with your purchase. I always tell my clients that the first property and the right property can always set the foundation for your future growth. And that's why preparation to buy a house is actually more important than the process of buying a house itself. If you found this video helpful, share it with your friends and family, give it a thumbs up, and I'll see you in the next video.